We are live.
Thank you, Carmen. I bring you greetings from Omega Lambda Omega chapter of Alpha Kappa Alpha Sorority Incorporated. My name is Felicia Lowry Herndon, and I am the president of our outstanding chapter. We serve North Raleigh and Franklin County areas of Alpha Kappa Alpha. This is part 3 of our 4-part series of our financial series, Financial Literacy. Please feel free to follow us on Facebook and visit our website regularly for our programs. Welcome.
Thank you, Felicia. Hi, everyone. Welcome again on behalf of OLO. My name is LaShara Owens, and I am the co-chairman for Building Your Economic Legacy Committee. And as Felicia mentioned, this is the 3rd part of our 4-part virtual financial literacy series. And I will be sharing a couple of tips with you in order to for us to better communicate and listen in tonight. All lines are muted right now. Please do not unmute unless you have a question. Please add all questions to the monitor chat box. We will be watching that and asking the questions accordingly. Please participate in the poll questions. You will see those throughout the presentations. Please add your email address if you would like to be contacted by either one of our presenters tonight for more information. Please position your cameras properly if you would like us to see your lovely faces tonight. And again, welcome and thank you for joining us.
Good evening, everyone. My name is Shima Caraway, and I am the other co-chairman of the Building Your Economic Legacy target for the Omega Lambda Omega chapter of Alpha Kappa Alpha Sorority Incorporated. Tonight, we've got something super special for you. I'm not sure if you are a first-time home buyer or you're looking to upgrade, but we've got 2 amazingly brutally honest professionals tonight who are going to give you more than what you would find on the internet or get at those first-time home buyers seminars. They're going to give you those secrets and those little watch outs that nobody ever tells you. So we have 2 speakers. Chuck Jones is the broker in charge for Jones Advantage Real Estate. He has been in the real estate and finance industry for 20 years. He is a graduate of Winston-Salem State University with a degree in finance. He also played basketball for the Winston-Salem State Rams. In his spare time, he uses those skills to coach his younger son in basketball to prepare him for college like he did his older son, who is now at Vanderbilt coaching down in Nashville, Tennessee. Lastly, Chuck is a proud member of Omega Psi Phi Fraternity Incorporated, and I'd like to wish them a very happy Founders Day, and I apologize for booking him on this day. But he has some great information for you. Our second speaker is Nicola Watson-Joe, and she is a mortgage loan originator with PNC Bank serving the Triangle. She has 25 years in the banking and finance industry, and she has been dedicated to helping clients reach their financial goals and navigate complex financial needs. Nicola is from Charlotte, North Carolina. She received her Bachelor of Arts degree in psychology in '89 from UNCG. She lives in Raleigh with her husband and 3 sons. And in her spare time, she is a track mom, supporting her younger 2 sons and doting on her oldest son, of whom she is exceptionally proud. So without further ado, Mr. Chuck Jones. You might have to go a little bit. Can you see him okay?
Hello?
They're all muted.
Okay. Can everybody see me?
Yes.
Okay, thanks. Good evening, everyone. I really appreciate you having me here tonight, just to give you a little information on the home buying process. Right now is a very different time in the Triangle. I haven't seen a time like this since maybe 04, 05. It's really become a seller's market. Right now, houses that are, it's almost impossible to find anything under 200,000. And when I say that, I mean townhomes is really rough out there, because you're competing with a lot of the banks and investment companies, and hedge funds that are going out, and they feel like the Raleigh-Durham Triangle market is a great place to invest their clients' money. So, it's made it even harder to actually purchase something. The first thing that I would say to someone who wants to go out and purchase a home, whether it be your first home or your third home, is make sure to prepare your finances. You want to make sure that you have your down payment money together. There's a new thing. If you haven't purchased a home in the last 4 or 5 years, there's a thing called due diligence money now. Back 5, 6 years ago, you could go in, put a house under contract, and basically you had, whatever, the amount of time that your agent negotiated for you, usually 3 weeks to a month, to do all of your appraisals and inspections and to make sure that your mortgage was in place. And if at on the third week of that, say for instance, you found out you didn't qualify for what you thought you qualified for, or the inspection was bad and you couldn't agree to repairs, you could get your money back. They give you your money back, and it's no harm, no foul. But the rules have changed, the contracts have changed. So now there's what's called due diligence money, and with due diligence money, it's non-refundable. So when you go to buy a home now, you have to have due diligence as well as earnest money. And back 4 or 5 years ago, you could go in and you could put down $500 in earnest money and have your offer accepted. Today, if you go in and you try to put down $500 in earnest money, they're not even really gonna look at your offer. Right now I just sold one 2 weeks ago. It's $250,000 home. The due diligence was $5,000 non-refundable. And with that, it kind of puts you in a situation. And when I say a situation, you already have $5,000 in the process. So, if you go through the process and say, there's something wrong with the electrical, you have electrical or plumbing problem or something of that nature, and they say they don't want to fix it, what are you going to do? Are you going to walk away from your 5,000 because they don't want to fix a $1,500 problem? Probably not. But if, that's the new landscape that presents itself. So that's big. So you really want to make sure that you're watching for that type stuff. And one of the things that throw up a caution sign for you is if you look at a property and it's been in the contract 2 or 3 times and it keeps going on the contract and then coming back on the market and then it's pending and then it's back on the market. A lot of times your agent needs to ask a couple of questions to kind of find out why that's the case. Also, when you're preparing your finances, you need to, definitely speak with the loan officer and find out what you pre-qualify for. Now, just because you pre-qualify for 500,000, that doesn't mean you necessarily want to purchase 500,000. You go in, and because they don't take into account all of the things that you have happening in your life. If you make $100,000 and you have one kid, and your credit card debt and your car payment is helps you to qualify for $350,000 or $400,000 house. It's not the same as if you make that same amount of money and you have 6 kids. So they can't tell you what your monthly bills are. So just because you qualify for that amount of money doesn't mean you want to spend all that money. And then you need to look at some of the other things. You need to look at, what your taxes are, what your insurance is going to be, what the upkeep on that is going to be, how much your inspections are going to cost. Are you going to have to pay for your appraisal up front? There's a lot of things that kind of go into that. The next thing you want to do when you're thinking about your finances is, you want to, find the right loan. And I'm sure that they're going to speak to this a little later. There are a lot of different types of loans out there, depending on location and down payment assistance programs and things of that nature. So you definitely want to, make sure you're taking advantage of, all the stuff that's out there, but I won't get too deep into that. One of the most important things that I tell people is when you find your property, get it. You really want to narrow your search and know where you want to be at. You don't want to just get out there and ride all over the world and, waste time looking at a house and, it's something that you probably don't want. You're just riding just for the sake of riding. The thing is, the markets are so competitive now. If you see a house, you better make a strong offer. Go ahead and make your best offer first. Don't come in. This is not the market where you go in and you see a house that's priced at $300,000 and you say, well, let's offer them $290 and see what they say. Your offer 9 times out of 10, they're not even going to consider it because somebody's going to offer them that $300,000 if the house will appraise for that. Your agent, they'll be able to pull comps and tell you, hey, the numbers look like they're where they're supposed to be at. So we probably want to get our best offer in initially, because what's going to happen if you have a house that's in that anywhere from that $200,000 to $350,000 range, is if it's been built within the last 10 years or so, it's not going to last. It's only going to last about a week at the most. And the only reason that it's lasting a week on the market is because the agent is holding the offers and they want to make sure that their client gets multiple offers so that they can try to push the price up on that thing. So, just know when you're going in, make sure you put your best foot forward initially. Know you need to give good earnest money, good due diligence money. And like I said, the due diligence money is non-refundable. So, just beware of that. But make your best offer. Don't go in thinking that, this is 6 or 7 years ago, because you'll be without a home for a while. And the thing, and I don't want you to take this the wrong way, but, I've had clients say to me, hey, I want to go home and pray on this. Just being honest with you, you need to go ahead and pray before you get there, because people are buying houses. They're gone before you can, before you can even think about it or talk about it. Usually if I have a client and they like a property, before we leave that neighborhood, I'm calling the agent to see if they have any pending offers and how long it's going to be before they actually accept an offer. One thing that you want to take into consideration, a lot of times price is the only thing that a lot of people look at. You really want to take a look at the school system. You want to know, hey, are my kids going to be fine here? Because the thing is, if you go in and you buy a house and the school system ends up not being what you want it to be, you're going to end up sending them to private school or something like that and incurring an extra expense when you could have, just put that into your house and had them in a little better school situation. And you also want to take into consideration your commute to work back and forth. I know it's not something that people are worried about right now because so many people are working from home, but that commute going back and forth to work, if you're driving, the difference in a 20-minute commute back and forth to work and a 45, and to be honest with you, there are a lot of people right now that they're priced out of the Raleigh market. They're even priced out of the Clayton market. So you have people now that work in Raleigh and they're having to move to Smithfield or Wilson or Creedmoor or Henderson, and the thing is, their gas is up. You're spending an extra $40-50 a month in gas, all that extra wear and tear on your car. Those are not things that they're taking into consideration. You're just looking at the price, and sometimes it's a situation where that's all you qualify for, so that's what you have to do. But it's definitely something that you want to take into consideration when you're going out and you're home shopping. The next thing I would tell you is get ready for the ups and downs. The whole process is sometimes it's not a clean process. You have to really lean on your agent and your loan officer for a lot of this stuff. Your appraisal could come in, a little lower than what you expect, and they might have to do some negotiations there. You might have an inspection that comes in a little differently than you wanted. And a lot of times when I have clients that have inspections, I forewarn them. I don't care. You can have a brand new house that can just be built. The inspector is going to find something. There's going to be a list and you have a brand new house and there may be 10 things up there and the list looks long, but a lot of times it's small stuff, like a doorknob needs to be adjusted, or there's a light bulb that's blown, or you have some cracks in your vinyl outside because the lawnmower kicked up some rocks, or little things like that. Don't let that little stuff scare you. Little stuff like that, that's minor. Now you start talking about you need a new roof or a new HVAC system or the foundation, there are issues with that those are things that you really want to step back and consider, because those are $8,000 to $10,000 problems. So that's something serious. But don't let some doorknobs or some paint or carpet deter you from buying the home that you love. And now when you start talking about doing construction stuff where you're going in and putting a new roof, or you have to do something with the framing, really pay attention to that. And you really want to pay attention to it now more than ever, because the numbers have increased so much. Say for instance, you had something priced a year ago and someone told you, well, if you buy this house, we can go in and we can build you an addition for about $25,000-$30,000, and you're depending on that number. Just know that that's not going to be the same number right now. For one, the demand on these contractors is sky high, so everybody's charging their top number and they're getting it. The other thing that you're going to run into is material costs have gone up so much. Just to give you an example, an 8-foot 2x4 last year this time would cost you about $4.50. Right now, if you wanted the same board, you would have to pay about $8.25 for that same piece of wood. So, if you're going in and you're building a house and you have 600 or 700 of these boards, or 200 or 300 even, you've doubled your cost there, and the other materials have kind of, done the same thing. So, make sure that, you take all that into consideration. Another thing that I would say to you that I know your mortgage broker is going to appreciate is, hold on through that process. It's going to take you between 45 and 60 days, depending on the type of loan you do, especially if you're going to do something like a USDA loan, which is 100% product that requires, it needs to go through underwriting twice. So, just be patient with your mortgage broker and know that they're, working, very hard for you, and they're going to get that thing done. They want to get it done as bad as you do, because they don't get paid unless, your deal closes. So, just beware that right now the market, just the whole industry we're just understaffed, especially on the mortgage side. You have all these refis going in because rates are so low right now that, it's just tough. So your loan officers doing everything they can, but they depend on underwriters and appraisers and other people. So, make sure that you're patient with them, because they're doing everything they can for you. The last thing that I would say is, when you go to closing, know what to expect. Know that you're going to get your numbers 3 days prior to closing. They have to send you what's called a CD 3 days prior to closing. So make sure when you get that CD, you go over it, you look, okay, this cost is going here, this cost is going there. This is kind of what we agreed upon. And, 99% of the time, that's going to be the case. A lot of times people get some things confused and think that the mortgage broker is actually, charging them all of this money with, for closing costs that they're not. You have things called escrows, which are your taxes and insurance. And with your taxes and insurance, there's nothing that, your mortgage broker can do about that. The mortgage broker can't control what the attorney charges or any of that stuff. So, don't get confused when you see, my closing costs were $8,000. With that $8,000, the city of Raleigh or the city of Durham may be getting 3,000 of that, and then your insurance company may be getting another 1,500 of that. So, when you go, just have that expectation, and just review everything a couple of days prior to, so that you know what you're walking into. And when you go to your closing, make sure you bring your ID. It's probably going to take you about an hour or so, unless, with most lenders, it's going to take you about an hour or so to close. So, just be prepared for that. And that's pretty much my spill on it. Is there anything, does anyone else have any questions or
What does CD stand for?
Oh, I'm sorry, CD. Those are just your closing numbers. Those they used to call it a HUD closing disclosure. Yeah, they used to call it a HUD. Now they call it this. They said that they're going to send the CD out, and it just basically breaks down all of the numbers. All of your numbers. It's going to tell you what your interest rate is on it, what your payment is. It's going to tell you about your taxes, how much you're paying in insurance. It's going to break down what the attorney's fees were, the title insurance. Your title insurance is something that every lender is going to make you have. It's just something that ensures that if there are any liens on the property that the attorney missed, that the title insurance company will take care of that for you. But yeah, that's very important. Like I said, you really want to make sure that you pay attention to that and go over it with your mortgage broker as well as your agent. And like I said, you have to get it, it's the law that you have to have that 3 days prior to closing. So, you'll have plenty of time to look at it and ask any questions that you may have.
Right now, I put up the poll question asking if this is your first home buyer seminar, and it looks like we have 73%. I'll leave it in for another 5 seconds if you want to click yes or no really quick, and then I will be able to give you that information. Okay. In the polling, it looks like 61%, this is their first home buying seminar, and 39%, it's not their first.
No, I see a question that says on average it's still 20% down for closing costs. No, it's not. It's definitely not that bad. Usually a lot of it depends on the time of the year, because like I said, a lot of the fees and closing costs that are included are your insurance and your taxes. And depending on what time of the year it is and the size of the house, just like right now, your taxes and everything have just been paid. So your escrows aren't as much as they would be if you had purchased a home in July or August, because you would have to have about 6 or 8 months, in that escrow. So no, and your escrow is your taxes and insurance. With your house payment, your payment includes your principal and interest, your taxes and insurance, as well as your mortgage insurance. And I know you're going to get a little bit of that information later, so I don't want to get into too much of that. I'll definitely let the experts speak on that, but that's just the little overview of what goes into that. The coronavirus pandemic, and this will sound crazy, but it has affected absolutely nothing. As a matter of fact, it may have caused things to actually be more expensive because you can't find, people aren't working the way that they were working. You can't get supplies in the way that they would have come in if it weren't for the pandemic. Trying to find, I had a client that wanted to close on the house, and we had a refrigerator was part of her closing package. We ordered the refrigerator was ordered for 3 months, and it wasn't, because nothing is being shipped, nothing is being done. It's rough right now. A lot of people don't want to come to work, so you don't have as much product. Demand is high and the supply isn't as high as it should be, especially with all of these hedge funds coming in and buying up all the properties in Raleigh. Like I said, it's rough out here right now. If you're looking for a $250,000 house, you need to know when you go in, if that house looks anything like anything, you're going to be competing against 4 or 5 offers. That's just regular. I promise you, there's no way you're going to find a $250,000 to $300,000 house and it not have multiple offers. And that's another thing that I'll tell you, I want to touch on a little bit. When you're going out to list your property, if you're trying to sell your property, because I know some of you might have to sell in order to buy something else, and make sure you look at how hard it's going to be to sell your property when you're negotiating your fees. If you're in the neighborhood, I would always tell a person, make sure they have an agent, but some companies are charging like 7%, and I can't tell anybody what they're worth. If you feel like you're worth 7%, or, hey, someone's going to pay you, hey, take it. But, if you want to pay them, hey, give it to them. But I know personally there's no way I would pay that. Not when I know, if I'm in that $250,000 to $300,000 price range, my house is going to sell, within 2 weeks. It's not going to be a hard sale. So, I definitely wouldn't do that. Let me see. Let's see. What are your feelings on companies like Open Door and Zillow buying and selling homes without the typical real estate agent to help them? I think Zillow and Open Door, they're not bad services. For some people, that's your best option. If you want to maximize what you're going to get for your home, I wouldn't I wouldn't do that. And that's just my opinion. And the reason I say that is with Zillow and what is it, Zillow and Open Door, they're going to come in, they're a company and they want to make a profit on your home. So what they're going to do is they're going to give you an offer, and it's going to be an okay offer, but you're going to end up, I had a client, well, wasn't my client, it was a house that my client bought. Zillow came in and told them they would give them $170,000 for their home. We ended up in a multiple offer situation because they decided not to go with Zillow. We ended up with multiple offers and we squeaked out the home, and we ended up paying $189,000 for that house. So if that person had sold their home to Zillow, they would have gotten 170. But they worked with an agent, and the agent, I saw the HUD, the agent charged them 5%, which was about $9,000. So they ended up making an additional $10,000 that they wouldn't have made even with paying the agent fees. So, hey, if it's a situation where, listen, I don't want to show my home to people, I don't want people in my home, I just want one person to come here, you can do that. But at the same time, it's a disadvantage to you because, people are not competing. You're basically going to let them come in and make all the property and take away from the equity that you worked hard and lived in this house to build. Any advice with buying foreclosures right now? That's a great question. The thing that I would tell you is there are not many. It's hard to find a foreclosure right now. If a house, like I said, if a house goes on the market, say for instance, my house was about to go into foreclosure, the bank does not want your house. That's the thing that people don't realize. They do not want your house. They don't want to go through the process of hiring an attorney and going on the courthouse steps and having to take the house and having to evict you. They do not want your house. So they're going to work with you. So say for instance, you have a house, it's 300,000. If you put that house on the market and it's anything close to being ready, if you put that thing on the market, it's going to sell in a week. So the chances of it going on foreclosure are like slim and none. Back in 08, 09, when there were all these houses going on the market and, people couldn't get the numbers that they owed, it was different. But now it's the exact opposite. You have people that are coming in and, houses are appreciating at, 4%, even 5% in some places every year. Things have slowed down a little bit on the appreciation side, but we're still appreciating at a high rate. So it's really hard to find foreclosures right now, especially in the Raleigh-Durham area. One of the best places to look for foreclosures, though, of course, ask your agent. They have special tools to find those. But if you want to go out on your own and try to find some, go to a website called HUD, HUD, Home, HOME store.com. If you go there, you can plug in any city in the state of North Carolina. As a matter of fact, all over the country, you can look in and it'll show you all the foreclosures in different areas. Just to give you some idea, I used to list homes for that company and used to do 7 or 8 of those a month. And there were 3 or 4 other agents that used to do the same amount. I look on the website periodically, and most of the time, if I put in Wake County, there are not any, where there used to be, 10 or 11 properties up there at any one time. If you look there now, you can't find anything. I can't say it's always going to be like that. And it's a good thing that it's not like that. That means people are doing okay and they're keeping their homes and, they're in a lot better situations. But like I said, the foreclosure market right now is nothing close to what it used to be. I can definitely put that in the chat. I'm gonna have to get someone to help me with that, but I'll definitely get that in there. If someone would put HUD, HUD, home, HOME, store.com in there, that'd be great. What's an ideal credit score? Hold up, that's something you're, that's an ideal credit score.
It's a phone.
It's this is, I think I can't read that question. There's something there.
Hi, Chuck. I just want to make sure I have it right. It's hudhomestore.com.
Yep.
And that's to find foreclosures.
Yep, you can find
Okay.
foreclosures there. But like I said, it's tough. It's not like it used to be. There used to be plenty of homes there, but if you go there right now, if you put in Wake County, you might see one or two. And it used to be a great situation. I had investors that would flip homes. We would go up there, and I knew how to play with the numbers, and I could get you a great deal. And we'd go in, and we go in homes and put a little carpet, some paint, maybe change out some bathroom fixtures, and they make $30,000-$40,000 like it was nothing. Now, there's no meat on the bone. So you go in and you're basically paying market for those properties because, like I said, there's so much of demand for them. What's an ideal credit score when buying a home? What are the risks lenders look at that would make your application get declined? I'm going to let Nicole, speak. Speak to that. I know she's a lot more knowledgeable about that than I am. I do know a lot of that stuff, but I'm gonna let her talk about that when she gets on. Can you share information about the Good Neighbor Next Door program? I've been told that foreclosed homes. As a matter of fact, that's a great program. That program is for policemen, firemen, doctors, nurses. It's a great program. It's still out there. It's, as a matter of fact, that website that I just gave you, that's where you can find out a lot of information on that program. Though the houses on that program, there used to be a couple of houses here or there that would qualify for that program, but you could get them for, if the house was listed for $120,000 on that website, you could go in and they'd sell you the house for $60,000. There were a couple of stipulations. You had to stay in the house a certain amount of time. I think it was 10 years. After the 6th year, they would take 20% off of what they gave you, and then by the end of the time, you didn't have to repay anything after 10 years. It's a great program, but there were only a few houses on that site that they would actually let you use that program on. But if you go to the hudhomestore.com, you can get a lot more information on that. But there are none, to be honest with you, there are none of those homes in Raleigh right now. If you go out to like some of the smaller towns, way out, like a Kinston or somewhere, and I haven't seen any in Kinston in a while, but if you go out to some of the smaller towns, maybe even Henderson, you might be able to find one here or there. Or if you go to some of the other markets that are a little more depressed, like Michigan or something like Utah. Well, Utah's they've come back and they're pretty hot, but they're doing a lot more of those homes in the Midwest where the economy is a lot worse off because some of the manufacturing jobs have been lost, but not a lot in the Raleigh area.
Chuck, I have a question from Facebook coming in.
Okay.
Is FHA the best option for first-time home buyers?
Not necessarily. FHA is a great program. It's 3.5% down. But there's some great programs out there. USDA is a 100% program. The thing with FHA is you have mortgage insurance, and with some of these other, and that mortgage insurance stays with you for a long time. With a lot of these down payment assistance programs, it's not your best option. Sometimes it is, though. It's on a case by case. And that's something that, Nicola, she's going to speak to for you, and get into that. You have to she wants to sit down. Once she sits down with you and sees your whole picture, she'll be able to tell you, hey, this is probably the way we want to go. You have about 10,000. I can get you a little down payment assistance money over here, and we can make this thing happen. Or if you're sitting there and you have $50,000 in the bank, and you're like, hey, it doesn't matter, I want to put 20% down and not have to pay mortgage insurance, because mortgage insurance is absolutely useless to you. So if at any time you can duck paying that's, it's a great thing. So, but I know she's going to definitely speak to those things.
Okay, I am going to put up the next poll for the group, and I'm going to launch it right now and give everyone about a minute or two. Please continue to add questions to the chat, but I'm going to add this. And for Facebook, since there's a slight delay, the question that's on the Zoom poll is, what best describes you? First-time home buyer, step up, upgrade to a new home, or you're in the research phase? Please feel free to share your answers on the Facebook comments, please.
We can. I just moved back to Raleigh, and everyone's telling me to move to Johnston County because Wade County taxes are higher. If I want to live in Raleigh, is there any way I could, I guess, keep taxes low or trade off for something? The thing that I would say is the taxes in Wade County aren't a lot more expensive than they are in Johnston County. And the trade-off is if you work in Raleigh, your taxes might be, if you're looking at a $200,000 house, you're going to have, your taxes on that house in Raleigh might be 50 or 60 bucks more a month. The thing is, if you have to drive from Johnston County to Raleigh every day to work, you're going to spend that in gas in a week, and it's the wear and tear on your car, the oil changes. And then you have to ask yourself, how much is my time worth? Is this extra hour and 15 minutes that I'm spending in my car away from my family, my kids, and all the other things that I have going on that I enjoy, is it worth that? So, hey, I don't, it's not worth the trade-off for me. Now, I was actually one of those people that, when I bought the house that I'm in now, I moved about 5 minutes further out because the house was it was a lot cheaper, where in the neighborhood that I wanted to be in. I moved out to Roseville before we had anything other than a McDonald's. So, it was, the houses were a lot cheaper then. It's not that way now. So, I lucked up and made a good move, but, 5 minutes, I could handle, the extra 5 minutes a day or so. And then the thing is, I don't drive with traffic. Being that I do what I do, I can leave when I want to leave. So I can kind of, that 7:30 traffic, I don't really have to worry about that unless I'm, taking my son to school. What's the advantage of working with a realtor? There are a lot of advantages of working with a realtor. This is something that I do. Most people are going to buy, maybe 2-3 houses in their lifetime. And during the course of that time, if you bought a house 5-6 years ago, there are a lot of things that are different now. Like I said, due diligence money is something that you didn't experience. It's very real right now. What a house cost 5 or 6 years ago is not the same. You're going to end up spending a lot more now. Houses. I was looking on MLS a little earlier, and I saw a house that was listed in probably around 2009, 2010 for about $68,000. I just looked at it a few minutes ago, and it was listed for about $190. So, things are, and not all houses have done that, but, there are some situations where, that's what's going on. The thing that you need to know also is the seller pays the real estate agent. Whether you use a real estate agent or not, you're not going to get a discount 9 times out of 10, because what's going to happen is the seller's already worked out with the realtor what they're going to pay in fees. So just say, for instance, they've worked it out and they're going to pay 6%. A lot of times what happens is the listing agent will try to get 3.5%, or sometimes they'll be fair and split it 3% and 3%. But if the other person doesn't have an agent, a lot of times that agent is just going to take the whole 6% to themselves. So, so you going in thinking, well, I'm going to save some money because I don't have an agent. That doesn't work. And a lot of times you're going to end up in situations where people are telling you things and you have no idea if they're telling you the right thing. Like when you go into these new home communities, the thing that I tell people is talk very little, because that person that's in that new home community, they work for that builder. They're trying to help that builder out. So it's their job to tell the builder everything that you tell them. So if you go in, just say for instance, you go into one of these new home communities and you see a house and they're saying, hey, we're building this new house. We have it listed for $300,000. You go in there, and depending on the time of year, like different builders have different ends to their fiscal year. So Lennar Homes. So if you're going in and looking at a Lennar home, the thing that you need to know is 11/30 is a very important day for them. That's the end of their fiscal year when all their reports come out that tells how much inventory they have on hand. And they don't want inventory. They want everything to look good because when their investors see their numbers, they want to feel good about things. So, if you go over to a Lennar Homes community and you hook up to their Wi-Fi, the passcode is November the 30th. That's just how important that date is. So if you go in there on a normal year and you negotiate $4,000 or $5,000, or you ask for a refrigerator, or you ask for some blinds or things of that nature, you have a good chance of getting it in November. October, because they want to close it by November the 30th. So you have a great chance of getting it. If you go in, say, April, May, June, July, the chances of you getting that are not as good. And that's something that you would know as just as a buyer. Someone doing this, only a couple of times. And like I said, if you go in there and you say, hey, you tell that agent, hey, I really like this house. My wife, she just got a job here. We have to be here in a month and a half. We're going to offer them $295, but we'll really pay the $300,000 for it. Or we're going to answer a refrigerator and blinds, but we don't care if we get that. We'll take this house anyway. So you're saying that to this agent, and you're thinking that because they gave you a bottle of water and some cookies that they're your friend. They're not your friend. Their job is to go back and tell their seller, hey, they just told me that they have to be here in the next 6 weeks, that his wife just got a job here. They have to be here. They're going to offer this, but they'll pay this. If they don't do that, they're not doing their job. So the thing you need to know is the agent in that place represents the seller. And the thing is, they're even going to give you a piece of paper. They're probably not going to explain that paper to you properly, but they're going to give you a document and basically have you sign that document just saying, hey, we just told you that we don't represent you. We represent the builder. So, always make sure that you're aware of that when you're going in there, and don't act too excited about the house. Even if you like it, get with your agent and let them negotiate that thing for you. Could you share when the fiscal end is? I think they're closer to September, October. I had to look it up, but most of them are right there. What happens in a normal year is on new homes. This is not all homes, but if you really, really pay attention to it, every year around I'll give you the whole cycle. The cycle of things is April, when daylight savings time kicks in. That's kind of like Black Friday for Christmas. So what happens is everybody gets into that home buying mode. You have a little extra daylight time, it's getting warm outside. So everybody starts to kick up a little bit. So you start to search your Zillow and your realtor. And what you want to do, and let me give you some advice on this. If you're going to look for a home and you want to use a site, use realtor.com. That's the most accurate site. They're updated every 15 minutes. So you are able to see what's going on, like Zillow and Trulia and these other websites. They'll have information up there that might be 2 or 3 days old. And in the triangle, things are changing so much in 2 or 3 days that, that's not good, because you're calling about a house that's been in the contract for 2 days. But what's going to happen is April is like I said, that's like Black Friday. That's the first day, we get daylight savings time. Everybody gets, it gets warm outside, and all of a sudden, you're shaking the cold weather off, the cobwebs, and you're out and you're looking for stuff. So April, things get warm. May, things get a little warmer. And then June, all of a sudden, your kids get out of school. So now all of a sudden, we're the week before Christmas. We're 2 weeks out, week before Christmas. And right now you need that present. You need your house because you want to be closed by August at the latest, the beginning of September, because you need to know where your kids are going to go to school. You want to be able to go ahead and get them registered and have all that stuff out the way. You don't want to be rushing at the last minute and not knowing where you're going to have them in school at. So when you're looking July, August, September, I'm talking about houses are flying off. So the builders are trying to make sure that their inventory, they have a lot of inventory so that people have a lot of choices and, they'll use them. But what happens is in a normal year, there's some inventory that's left over because, the builders, just like after Christmas, you have the after Christmas sale. And it's not like the after Christmas sale where you're going to get 50% off, but a lot of times, especially like on a Lennar home, September comes in, October, DR Horton, and if you look, DR Horton this year, about a month and a half ago, maybe 2 months ago, they were offering, they're going to pay all your credit, your closing costs, refrigerator, blinds, or $10,000 in upgrade. They were paying agents 4% bonuses because they just want to get rid of those houses. So, the time of the year really matters. And then what happens is, around now, things, people are ready for the holidays. People are not, in a normal year, people are still shopping right now, but it's not like it was. Like I looked online before I got on this call and I saw a couple of townhouses out there in Raleigh that were decent. Some in Addison Reserve, which is right off of Perry Creek Road, if you're familiar. And there were a couple of others right off of 401 that I saw that were right around 200,000. They'd only been on the market for about 3 or 4 days. So 9 times out of 10, they have an offer or two on those things. But to be honest, they weren't lasting 3 or 4 days at one time. You had people coming in making cash offers, especially these hedge funds. So, things have slowed down a little bit, but, the market is still very active. Use Realtor start. Okay. I see someone put userealtor.com.
Yeah, I just wanted to share the poll results from the audience that we have here. We have about 29% that are first-time home buyers or would be. 24% are looking to step it up and upgrade their home. And then we have 47% that are currently in the research phase. So that's for you and Nicola.
Like I said, you definitely want to speak to your lender first. You want to speak with Nicola so that she can, help you figure out how much house you can actually afford. And then once you, and like I said, you might qualify for more house than you want. Like say for instance, like you qualify for that 500,000. You're looking, if you looking at 500,000, a lot of times that payment is, you're looking at a $3,200, $3,300 payment. You want to go in and see, hey, what would be my payment on this 400,000, or what would be my payment if I use the USDA, or what would be my payment if we did an FHA loan, if it actually qualifies, for either of those programs. So, that's definitely something, you want to ask Nicola about. I know she's been in the business 25 years, so she's seen the good, bad, and ugly, Were there any other questions? Well, I appreciate it. I'm about to go spend some time with the greatest fraternity in the world.
Lord.
You enjoy the rest of the night, and if there are any of my brothers in here, root to the good team. Hey, if you want to ask more questions, include in the chat. And my email address is Jones, JONES, Advantage, ADVANTAGE @gmail. You can give me a call. Please give me a call. Don't text me. My wife, she keeps me in a whole bunch of group texts, and sometimes I miss some important stuff. So if you want, if you have a question, please give me a call. I'm available. I work till 8:30, 9 o'clock. So don't feel bad about calling me at 8:30, 9 o'clock. If I'm doing something, I'll definitely give you a call right back, or, definitely get back in contact with you the next day. So, please give me a call with any questions.
All right.
Thank you.
Thank you so much, Chuck. I honestly did not realize it was his Founders Day when we booked him, but I've seen a lot of questions in the chat about financing, and Nicola has been waiting patiently, and I think Chuck said your name about 10, 12 times. So you ready, Nicola?
I'm ready to go. Thanks. Good evening, everyone, and thank you for joining. Chuck has really shared some very powerful information about the I guess the state of the market that we're in. And he's absolutely right that when you are considering home ownership, and whether you're a first-time home buyer or if you're going to upgrade, you really have to have everything lined up pretty quickly, because you got about 5 minutes to make a decision. That's just how hot the market is right now. So I'm going to talk a little bit about kind of how do you prepare for buying your first home, or how do you actually consider whether or not now's the time to refinance, or if you're looking to upgrade to a second home. First thing, whether you're a first-time home buyer or an experienced buyer, the mortgages that are displayed on this PowerPoint actually are available to virtually everyone. There's a fixed rate mortgage, which is a fixed term. You're familiar, most people are familiar with the 30-year mortgage, but there's a 20-year mortgage, there's a 15-year mortgage. But what that really does with a fixed rate mortgage is it guarantees that your rate is set, your monthly payment is set, aside from taxes and insurance, every month, and you can you have the security of the predictability of knowing where your monthly payment is. With an adjustable rate mortgage, that adjustable rate, well, let me take a step back. The fixed rate is good for the term of the adjustable rate. So for example, with an adjustable rate mortgage, there may be a 3-1 ARM or a 7-1 ARM or a 10-1 ARM. And what that means is for the 3-1 ARM, your rate is fixed for 3 years. And the 1 means it will change every year annually thereafter. 10 years, same thing. Your rate is fixed for the first 10 years, and then it will adjust thereafter. So you may ask, well, why would anyone do an adjustable rate mortgage? Adjustable rate mortgages are attractive in the scenario where you're buying your first house, you know you're not going to be there for 10 years, or you work in an industry where you most likely will have to move for one reason or another within a 5-year period, what have you. People are attracted to adjustable rate mortgages because sometimes the interest rates are lower. Not currently, but sometimes the adjustable rate mortgage will give you a lower interest rate, and the payment would be the same as a 30-year mortgage. VA loans, fantastic for my veterans, no closing costs, and in some cases with a VA refinance, no appraisal, no income docs, very clean process. So if you are a current active duty or a veteran, we always take a look at VA and see how that compares to conventional or conforming. And of course, affordable lending. Someone asked a question earlier about, is 20% still the guideline for a down payment? It's not. Whether you're buying or refinancing, you don't necessarily have to have 20% into the transaction. What the 20% number really identifies is whether or not you will pay private mortgage insurance in a conforming loan. Private mortgage insurance, and Chunk mentioned, is not for you. It really protects the lender against their interest in the loan because they are more than 80% into the value of the property, and you pay for that risk. Some of the programs we have actually allow you to put less than 20% down, and there's no PMI. So we can talk a little bit more about those when we get a little further into the presentation. Thanks, Shima. Any questions at this point?
I have a question from Facebook, and you can tell me if it's going to be later in your presentation, but it goes along with what you're saying about the amount to put down. So our question comes from Facebook, from Stein Garrett. And the question is, how much money should be saved up when looking at purchasing a home? I've always heard $5,000 at least, but is that required, or is it a percentage that a person should have in mind?
Okay, great. So let's talk about that. The minimum down payment that you'll be looking at for a first-time home buyer is 3%. So when you think about how much money you should really have set aside, you have to take into consideration the purchase price of the home. So for example, let's take a $250,000 home. 3% is your down payment, is about $7,500. But then there are also closing costs that you have to consider. Now, you may get a realtor and a seller that's willing to negotiate closing costs. It's It really depends on the market. I'm not seeing it as much now because the sellers don't have to. The house is going to move whether they pay or not. But if you're going to buy that $250,000 house, you need to have about $7,500 set aside for your down payment, and somewhere between $5,000 and $6,000 for closing costs. The closing costs include the processing fees associated with the transactions, such as your appraisal, your inspections, your title work, title insurance. But also rolled into that number is your escrow prepaids, because depending on when you close, there's a certain amount of taxes and insurance that have to be collected at the time of closing for taxes and insurance. I hope that
Thank
answers your question. Mhm. Okay, we can go to the next slide, please. Thank you. So do's and don'ts. And again, it applies to whether you're a first-time home buyer or whatever you're thinking about doing. Always, always reach out to a mortgage lender first. And I don't care if your timeline for purchasing a home is 3 months or a year from now. Let's have the conversation, because there are things that we can uncover and we can determine now to get you closer to being buyer ready. And it's better to find those things out a lot sooner than right when you're ready to buy and we discover that there's an issue that we can't overcome that's going to delay your purchase. Keep track of your income. Make sure that you are in a position where you can demonstrate and prove that you have consistent income. If you are a W-2 employee, we're going to be looking for 2 years W-2s, and you would answer any questions that would speak to any significant decrease or decline in your income based on W-2s. From an employment standpoint, we're not necessarily looking for 2 years employment with the same company, but we are looking for 2 years in the same industry or 2 years with the same type of income structure. So for example, if you were previously a teacher and you were a W-2 and now all of a sudden you're a contractor, you're on a 1099, that's not going to work. And that's going to present a problem. Organize your financial records and be able to get your hands on things, because the underwriters may ask for certain documentation that you might be, you may have, or you may have to actually reach out to like a 401k administrator to get, or if those are the funds that you're going to be using. Someone asked about keep your credit shining and what is the preferred credit score. Let me start by saying the best interest rates start with a credit score of 740 or higher. You can qualify for a mortgage with a score a lot lower than a 740. You're going to pay a little bit higher in the interest rate because that's a riskier loan to the lender. Your credit score minimum depends on a number of factors. What type of program you're actually going with. We've got programs and we can qualify you with a 640. I'm doing a 640 for a Lennar home right now. But the magic number is 740 for the best interest rates. The other thing, the don'ts, do not apply for any new credit when you're in the lending process. I had a couple under contract last year. They were supposed to close in December. They bought a car in November and they no longer qualified. So hold off on any major purchases. Unless there's an immediate need or something, let's delay a job change for the reasons I mentioned earlier, because we want to demonstrate consistency in income and consistency in employment. Make sure you're paying all your bills on time. One late pay in a short period of time before you apply, it will do significant damage to your credit score. And even if you're above a 640, you may have actually done damage to where your interest rate would be if your score was a 720 or a 740. The most important thing on this slide is open lines of communication with your lender. you should always feel free and comfortable having that conversation before you do something, or just kind of questioning kind of what's the process? What should I expect? And you should be working with a lender that lays that out for you clearly and gives you the opportunity to revisit any questions, because I promise you, you will have some throughout the process. And that working relationship is critically important.
Nicola, I have a question from Facebook.
Yes, ma'am.
Will student loans around the 75,000 mark affect your home ownership ratings with lenders if your salary is 75,000 a year?
So good question about student loans. Student loans are calculated into your debt to income ratio, whether they are deferred or not. So in the position where let's say you have your student loans in a 75,000, if you are in a deferred payment situation, and I know a lot of them are through the end of the year, we still have to calculate a payment, and we will calculate that payment as 1% of the outstanding balance. That's a lot higher than what your payment would actually be if you were in a payment structure. But the student loans, yes, they do count against your debt ratios, and they will impact the amount of home you can buy.
Thank you.
Okay, next slide, please. Thank you.
There was a question in the chat. I wanted to, since we took a break, let me ask that.
Okay.
Is it true that people who are self-employed have a harder time purchasing a home?
A self-employed income structure is challenging. It's not impossible. It's just a few extra steps that you have to go through, especially in this COVID environment. Here's what lenders are looking for self-employed. You must have 2 years business tax returns, or if you're a sole proprietor, you have to have reported a business income for 2 years. Here's what often happens with self-employed business tax returns. Everyone understands when you're self-employed, you're motivated to try to reduce your taxable income so that you're not paying as much in taxes. The problem with that is that's the income that we have to use to qualify you. So if you're thinking about purchasing a home and you are self-employed, we've got to have that 2 years, and make sure that you have the 2 years tax returns that actually are going to demonstrate your ability to pay. Also, when you're self-employed in this COVID environment, the industry that you're in is going to also impact the underwriter's review process, because if you are in a restaurant business or a hospitality business or an entertainer, then we've got to be able to substantiate that is, I guess, the probability of that income continuing. So let's get to the point where now you've decided I'm ready to buy a home. I've already done the preliminary work and I'm actually ready to go. We have a program that allows you to actually get a preliminary pre-approval letter right on the spot sent directly to your email by going to the website that does the application for you. The really cool thing about this is that we're not asking for any income documentation, no asset documentation. We're going to take your stated income. It's important that you're honest, because that's how we're going to base our pre-approval. The other thing is we're going to take your stated assets. So whatever you tell us you have set aside for down payment and closing costs is what we will use. We will pull your credit. So if you're not exactly ready to go, or you're not sure when you're going to be looking to buy, I would wait on this. We can do a pre-qualification, but not pull your credit. Sorry, I don't know why my phone did that. The digital preliminary pre-approval letter is almost a requirement right now in this market. And Chuck mentioned that really, before an agent is going to work with you, or before a seller is even going to consider your offer, they want to know that you are a serious buyer and that you're qualified. So the preliminary pre-approval actually is a must-have in this kind of a market right now. Oh, let me take a step back and mention about the prelim. The preliminary pre-approval is good for 120 days. If you find a home within that period, we don't have to pull your credit again. The letter itself expires in 90 days, but the credit report is good for 120. So if you're thinking about buying a house in the spring, then we need to talk about getting you preliminarily pre-approved January. Thank you. All right, so you've done your preliminary pre-approval and you're good to go. You're now shopping and you found a property. Once you've found a property, we will actually convert that preliminary pre-approval to a full application. And that's when we'll start collecting income and asset documentation from you. The documentation that we collect really depends on your financial situation, your pay structure, and the loan type that we're actually doing. So take a look at income verification. If you are a W-2 hourly or salaried person and you get a paycheck, we're going to collect your 2 most recent pay stubs. What we're looking for is that if you're hourly, is that the hours are consistent. There's not a significant decline in the number of hours, and that we can actually, again, expect that that income will reasonably continue. We'll collect 2 years of your W-2s. If you receive alimony, child support, separate maintenance, you can use that income as qualifying income for a mortgage. You don't have to, but you can. But what we're going to be looking for is proof that that income has been received for a minimum of 12 months. We also can take Social Security, 1099, disability income. A lot of different income sources can be used to qualify for a mortgage. The down payment funds. So many resources are available for down payments. You don't have to have that 20% down. You actually could get into a house with 3% down, and that 3% can come from a gift, from a family member, from a friend, somebody that's going to help you get into your first home. The provision is that the gift is not repayable, because if it's a loan, then we have to factor that into your debt ratios. But if they give you a gift for the full down payment or the closing costs or any portion of the expense of the transaction, that's acceptable depending on the program, and most of them accept a gift percentage. We also can do what's called a contingency mortgage. So let's say you're in a home currently and you want to buy a new home, but the money is tied up in your existing home. We can get you pre-qualified for the purchase of your new home with the anticipation that you're expecting $90,000 in proceeds from the sale of your current home. So what will happen is, before you close, obviously one has to close before you can buy the other. We will not count that mortgage payment against your debt ratios, and we will use the anticipated proceeds, and we'll collect the documentation once that property sells and use that for your down payment on the new home. Payment history, and again, back to your credit. Traditional credit, everybody knows how that works. That means you've had a number of credit trades in your file for a number of years. It's not the only way to go. We can do non-traditional credit for some first-time homebuyer programs, which means you don't necessarily get a credit score when we try to pull your credit, but you've rented an apartment for 2 years. You may have had a car payment. You've paid a cell phone or something, and you have 2 years history of that. We can build a credit score based on non-traditional sources as well. Once you go under contract, then you are going to provide all this documentation as well as the purchase contract, which your agent may send to me or you can send to me. And that's when I begin the process. And Chuck mentioned something that's very important. I'm glad he did. There are a lot of ups and downs. It's so many moving parts when purchasing or even refinancing a house that have to take place within a really short turnaround time to make the dream come true. There's a lot going on, and what's critically important to make your closing date is that you are highly responsive to your lender, because when they need something, we are in line with the underwriters. And Chuck even mentioned that everything is moving slow right now because of staffing and COVID and everything. If the underwriter gets to your file, we're missing something, and it takes you 3 days to send it in, we're at the bottom of the pile. So we're really going to challenge, we're in a challenge of whether or not we will meet our closing date. Thank you.
Nicola, we have a polling question if you're ready.
Yeah, sure.
So I'm going to launch the polling right now. The question is, what best describe your financial needs? And this is also for Facebook. What best describes your financial needs? Finance for a new home, refinance for a current home mortgage, finance for home improvements, or debt consolidation, or none of the above. And I'll give it about a minute. You could, if you have more though, you can continue. I'll just give it about a minute, and then
Great.
I'll close it and I can share the results with you.
Yeah, that'll be interesting. Someone asked earlier, is this a good time to refinance? That's a very specific question to your unique situation. I've had conversations with everyone about refinancing here recently because of everything people are seeing in the media about the lowest rates historically, et cetera, et cetera. Really, what determines whether or not a refinance is going to be cost effective to you is going to be based on your time horizon. How long do you plan to be in this house? If you're thinking about doing a conventional refinance, then there are upfront costs associated with that transaction that could either be rolled into the loan, which is going to increase your principal balance, or you can pay it out of pocket. But the question is really going to be, what is the net benefit for the refinance? Am I saving enough either in my monthly payment from my current mortgage, or from a long-term perspective, am I saving more in the overall interest paid over the life of the loan by refinancing the property? So that's really a cost-effective equation that we talk through to determine whether or not that makes sense. Now, we have, and some lenders are offering similar programs where you can actually refinance for little to no closing costs. Interest rates may be a little bit higher than what you're seeing, but if it makes sense compared to what your current mortgage is to refinance and not put $5,000 or $6,000 into the transaction and lower your current rate, then why not? I guess the rule of thumb there, everybody's like, well, if my rate's not at least a point lower than where I am, I shouldn't do it. That's not necessarily true. It's really a very unique analysis, and whether or not this is the time to refinance for you.
So we have the poll results. It looks like 34% are looking for financing for a new home. 16% are looking to refinance their current home mortgage. 13% are looking to finance home improvements. 19% are looking for debt consolidation, and 19% they're looking for nothing. They're just here because they want to hear your greatness.
Thank you. Let's talk about debt consolidation and finance home improvements. A lot of people don't think about using your home and the equity in your home for debt consolidation. That is often the smartest way to owe your debt, because you owe the debt regardless of whether it's on credit cards or if it's on your mortgage. You're going to pay a much lower interest rate on the mortgage. The sum of the payments that you're currently paying today on those credit cards will be reduced, even if you were to reduce the term on your mortgage and pay off those credit cards and reduce all of your debt, your monthly payment, and the interest over the term. I have had a lot of conversations with people who really thought they just wanted to refinance, and their rate is actually pretty good. It might even be about where we are now. But then when I delve a little bit deeper into their financial situation, we uncover they've got $15,000, $20,000 worth of credit card debt that they're paying 19% on. Why not roll that in, pay it off at 3.5% or whatever the rate is at the time, and eliminate those monthly payments, and your mortgage payment is not going to change significantly at all. save for home improvement. Use the house, the equity in the house, to pay for the house. So when you want to do carpet, you got to buy a new roof, you got to do a new HVAC. I've always said, let the house pay for the house. It's better to reinvest the equity back into the home because in the long run, you will benefit from that either by sale or appreciation. There was a question someone asked earlier.
I see a couple of questions, actually 3. So I can't remember if you said it because I was trying to review the questions, but did you say what a good rate is right now?
I did not, but we can talk about it, and we'll talk about rate and how rates are determined in just a minute. But that's a very, very specific
2
question.
more questions, and I'm not sure what you said to prompt this one, but she said, Shanti asked, are you speaking of a refinance with cash out? Is that the best way to go? I don't know if she's talking about when you were talking about the home improvement.
Or debt. I'll address them both. The refinance with cash out is one option if you're looking to do home improvement. And again, it really depends on, do you know exactly what you're going to do with the project? Do you have a pretty good estimate or concrete idea of how much it's going to cost or how much you intend to spend? If you do a cash out refinance at closing, we're going to pay off your mortgage and we're going to give you a check for the amount of cash. You begin making that payment immediately. But if you don't start your home improvement till next year, maybe a cash out refinance was not the right way to go. I always recommend for debt consolidation, a cash out refinance, simply because if my borrower is tempted by credit cards, the last thing I want to do is put them in another position with a line of credit. I'd much rather consolidate everything in a fixed payment, fixed term, and they can begin to benefit from the discipline of not having to use those credit cards because it's going to save them a considerable amount of money month to month.
And another question, is a HELOC a second mortgage?
That depends. If you have a first mortgage now, any subsequent lending that you do will be in second lien position. So a HELOC can be in second lien position if you have a first mortgage. I have seen and I have done HELOCs for homes that are paid in full, and the HELOC is not a second mortgage. We call that that's in first lien position. It's the only lien on the property.
Okay, so there was one question, and you may be able to answer this. I know we have shared this, the slides tonight in a PDF. It's at the very top of the chat, and I'll put it in again at the end of the workshop. But there was here, I'll go back to the slide, a checklist. Is that mortgage checklist available on the PNC website, or should they just contact you to have you email it to them?
They should probably contact me. There are a lot of resources on the PNC, on pnc.com, specifically under mortgage, like how much house can I afford, rent versus buy. There are a ton of resources. You can also go directly to my website or reach out to me, and we can kind of explore what your needs are and talk through it.
Do you want to give your website since you mentioned it before I ask that next question?
It's on the first slide.
Okay.
Yeah, and you can put it out there.
I'll go back to it at the end.
Thank you. I'm sorry.
Actually,
I don't want to speak wrong and give you the wrong site.
Another question was, with the adjustable rate, are there limits on how much the rate is allowed to go up in a certain time frame to protect buyers?
Yes, there is. There's a cap on adjustable rate mortgages, and depending on the terms of your specific mortgage, that will be determined when we quote the rate and when we lock the rate. The only thing that is fixed is the first duration, the first 3, 5, or 7 years of the adjustable rate mortgage, but there is a cap on how much it can go up. It can also go down.
Sorry, I just want to make sure that we didn't miss anything. Because like you said, I know that Chuck said a couple of times that you were going to talk about some things. Did you talk about is now a good time to refinance?
Yes, and what I spoke about that is, it's really unique to what your current position is in relationship to the net benefit of doing a refinance. And is it cost effective for you to do it based on,
Is there a downside then to refinancing?
a downside? Not really, but realistically, refinancing, if you go the conventional conforming way, it can be expensive. Right now in this market, a lot of lenders have kind of put their refinanced lending on pause. Some lenders have completely discontinued equity lending, like equity lines of credit, home equity, just because they're not doing it. PNC, for example, our turnaround on a conventional mortgage is 90 days. That's how long it's taken us to close them, just because of the sheer volume that we have. But if you're in the house already and you're going to get a better rate in 90 days, the timeline is really not going to make that much of a difference. Your rate is guaranteed for the entire 90 days that we're processing the loan.
Okay. So I have two more questions. I don't want to talk too much because we are getting close to our time, but I just want to, if you can wrap them into the rest of your presentation somehow. Yeah. One is to talk about discount points and how they work. Mm-hmm. And one, I just saw it. 1 second. Oh, and you did touch on this a little bit. What's an ideal credit score? You said 740 gets the best, 740 and above gets the best rate. And the risks that lenders look for that could make your get your application declined. And you talked about that a little bit too. So I don't know if you can wrap either of those, any more information about those into the rest of your presentation, or if you want to touch on them now.
Yes, sure. I can quickly answer both of them. The minimum credit score for PNC, and this is going to be for most lenders, is a 640. Someone asked earlier about, is FHA the best way to go? Not necessarily. FHA has recently increased their minimum credit score to a 700. So that may exclude someone who has a 675 that we would approve through any of our other programs. FHA is perfect for the right candidate. But to Chuck's point about private mortgage insurance, I don't care what your loan to value is or how much you pay down on your mortgage. If you're in an FHA, you cannot drop that PMI. You would have to refinance that mortgage. And that may not be the best position for you based on, how much you're putting into the transaction with your down payment. Points, that's a great question because most people don't understand points. So the best way to explain points, all lenders, I don't care who you're talking to, we all have the same rates. So when you hear rates are low or rates are high, what we're really referring to is the points equivalency that you pay to buy that rate. For example, most lenders, when they're showing you interest rates, that's with 1 point. So let's say they're showing you a 2.75. The question you always want to ask is, what are the points associated with that rate? They may say to you, well, that's with a 0.5 point. My 2.75 today is 0 points, which means you are not buying that rate. Actually, our 2.75 today is with the lender credit. So the lender could actually pay you to take a higher rate. Now, who wants to do that? Someone who doesn't have a lot of money for their down payment or closing costs. So we can actually, if you can take a higher rate and make the payment still comfortable, you can reduce the amount of closing costs when you go into the transaction because the lender will give you a credit. But the important thing, anybody you're talking to about interest rates, we all have the same rates. But the question is, what's the points and how much are you paying? Now, how do you calculate how much that actually translates into? The point is a calculation by the amount of the loan amount, however much you're actually going to finance. If it's 1 point, it's 1% of that. If it's a 0.5 point, half a percent of the loan amount. All right, so we talked a little bit about affordable housing solutions, and these programs are available whether you are buying, refinancing. We have a lot of things available to help people that are within certain income categories, or even are buying in a low to moderate income census tract. So you may have, for example, there's a lot of properties that have been revitalized in Raleigh, but the census tract has not changed. So you might be buying a $700,000 house in a low to moderate income census tract. If that's the case, you would qualify for what we call LMI, low to moderate income, special financing, which can give you money off of your closing costs, discount off of your interest rate. It's just an excellent program. And these apply to purchases and refinances. So how much money is it? PNC always has a grant for LMI financing. And this grant, again, is available to you based on your income and the county that you live in, as well as where the property is. So if you're just getting started and you're looking, you haven't found a property, but you know, we can talk about what your income is, you can almost always assume that you will qualify for the $1,500 that you can apply to your down payment, your closing costs, or even buy your rate down in points. Sometimes the grant is $2,000, sometimes it's even $3,000. Just to give you an idea about the PNC grant income levels right now, for Wake County, it's $72,000 a year. So if your income is under $72,000 and you don't own any other real estate property, you automatically qualify for the grant. So now for the fun part. You got pre-qualified and you found your home, you're under contract, everything, I'm sorry, you've got pre-qualified, you're ready to go. This is going to help your agent. House Hunter Checklist is going to help you determine what are the things that are most important to you when you're looking for your property. Start thinking about that, because there are a lot of different types of homes out there, and it can be overwhelming if you really haven't given thought to, where do I want to be? How many bedrooms? How many bathrooms? Do I want a first floor bedroom? What do I want in terms of location? All of those things are important. This actual worksheet will help you when you start shopping and you're looking at properties. It'll help you kind of organize and you can compare one to the other. Thank you very much for joining. I'm willing to answer any other questions you may have.
There was one more that I saw that said, what impact can foreclosure and bankruptcy have on buying a home?
So all lenders are processing through Fannie and Freddie. The requirement when you've had a foreclosure is that foreclosure has to have been completely resolved, which means that everything is filed at the Register of Deeds, and it has to be 7 years to the date before you can even apply for a new mortgage. I'm doing one now for a gentleman, and he had a foreclosure, and we're good to go. But we had a very specific date before we can even do the application. Bankruptcy, same thing. It's not a death sentence for buying a home, but it really is going to depend on what type of bankruptcy you filed, when was it discharged, and how have you managed your credit since.
Okay, I'm sorry, I have one more. I was just trying to take notes. Is there any advantage to getting mortgage through credit union versus commercial bank?
Well, here's what I can tell you about that. My experience is that the credit unions have a much smaller product suite than commercial banks. Some of them will only do a 5/1 adjustable rate mortgage. That's all they got. So when you go in, everybody gets a 5/1 ARM. That may not be the best program for you. They may not be able to offer some of the other affordable lending programs. When you're considering your lender, you're going to have to do a little bit of research. You're going to have to, go online, reach out to the lender, talk about the programs, talk about your unique situation to determine what really is going to be best for you, because maybe a 5/1 ARM is perfect. The myth is that the credit union rates are better. Not necessarily. Not necessarily.
I think that's it for the chat. Any in Facebook Live, Lasharo?
No, I don't see any on Facebook Live.
Okay, we're about 4 minutes over. It looks like we have concluded our questions. I just want to thank you so much again for attending today. Let's see. Do you want me to talk about this?
Yeah.
Thank you so much, Nicola, for your presentation. You've got some email addresses in here. People are reaching out. They would like for you to contact them. And I did add your website to the chat. And I also uploaded a file, a PDF at the top of the chat. If you cannot get it, let me know and I will upload it again. But it has all of the slides from tonight there, so you can contact Chuck Jones, who is the broker in charge of Jones Advantage Real Estate Professionals. And you can also contact Nicola Watson-Joe, loan originator with PNC. So we have one more session in 2020. We're going to end 2020 on a high note and get our economic legacy on track. And that is on December 1st with attorney Keith Shackelford. He will discuss wills and estate planning. I don't know if you have a will or it's been on your list of things to do. If you attended our first session, you heard Reggie Joe tell us we needed to get one. I think on our second session, we were told by Kimberly Winborn also told us we needed wills, we needed estates, we needed to plan our estates out. So we have someone in place if something goes on with our health that can take care of us. So we just need our documentation in order. So please join us again at 7 o'clock, December 1. Of course, you can register on olofaka.com or go through our Facebook page. But thank you again for joining us tonight. Have a wonderful Thanksgiving, socially distanced Thanksgiving.
I wanted to just jump in really quick and add to next week. We're hoping also that we cover powers of attorney, because everything that's going on with COVID, we want you all to be prepared, and please bring your family members and watch it with them. Now with everything going on, your family member could go into the hospital and not have any power of attorney, end up on a ventilator, and who is going to pay their bills or manage their accounts while they're there? So that's another thing we want to talk about. So please invite your family, aunties, uncles, grandparents to watch the next seminar with you.
Yeah, absolutely. It's a simple process, a group of forms, and Keith will take us through everything.
Yep.
So we'll see you on December 1 to get all of your financial documentation in order. Thank you so much for joining us tonight.
Thank you.
Good night.
Good night.